Welcome, my friends. What is up with Apple, you may ask? Well, something rare just happened. Barclays cuts Apple price target on concerns over demand weakness and slowing services growth. When is the last time that happened? But, when you think about it, what has Apple really invented lately? In fact, what has any big tech company really invented lately? And, Apple iPhone 14 sales are rumored to be slower than expected. And MacBook sales are confirmed to be down. Let's admit it, the iPhone 14 is really not a lot different than the 13. And a lot of iPhone users are still on iPhone 11 models. Barclays analysts said they are lowering their estimates for Apple. Analysts cite production problems and weakening demand. The analysts lowered their price target on the stock to $133 per share. That is down from $144 per share. Analysts are concerned that Apple services estimates are at risk. So, what does this mean for Apple? What does it mean for big tech companies? What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Barclays cut its revenue estimate by 7% for the first quarter, caused by a number of factors. Slowing services growth, continuing production problems, and weakening demand. What started out as production-driven cuts has moved to demand weakness across product categories, Barclays analysts wrote in a note. We are also concerned by decelerating services growth, the note continued. Apple struggled with iPhone 14 Pro shipments during the holiday season for a few reasons. There are COVID restrictions on its primary factory in China. Investors are also wary of rising interest rates. And consumer confidence overall is declining. All of these factors could hurt demand for Apple's premium-priced products. Shares of Apple were pretty much flat following the release of Barclays' note. In October, the world's biggest iPhone factory was hit with a COVID outbreak. The factory is located in Zhengzhou, China. The factory is run by Taiwanese company Foxconn. Foxconn imposed COVID lockdown restrictions. The factory then experienced worker protests over a pay dispute in November. Many of the employees basically went on strike. Foxconn has tried to entice workers back with pay bonuses. As things stand right now, Foxconn's Zhengzhou factory is almost back to full production. China has reversed course on its zero-COVID policy. Now, China is trying to reopen the economy. The policy of the Chinese Communist Party involved strict lockdowns. It also ordered mass testing to try to control the virus. But, backing off of the lockdown gave rise to COVID-19 outbreaks across large parts of China. And that could impact demand for iPhones. Apple also faces a potential slowdown in demand. The key challenge is expected to be on the demand side, said one Barclays analyst. That is especially true of customers for Apple's high-end products, the analyst continued. Affluent customers seem to have started to shift their spending to travel, the analyst also said. And some may have shifted their focus to medical supplies, the analyst also noted. The shift in spending will pose a key challenge in the short term, said Will Wang, research manager at IDC. Apple did not immediately make a representative available to respond to a request for comment. Apple has been a Wall Street darling for as long as most people can remember. Bank of America, B of A, downgraded of Apple in October to neutral from buy. The resulting sell-off vaporized $120 billion off its market cap. Apple's stock continues to be stronger than its big tech peers. Shares in Apple fell by over 25% in 2022. Which is actually much better than most big tech companies. The Nasdaq Composite was down 31% in 2022. But that does not mean that all Wall Street analysts are very optimistic. Apple reportedly cut iPhone 14 production by 6 million units. Demand for the iPhone 14 in China has been slow. China is one of Apple's most important markets. Inflation is raging in most countries of the world. Central banks in almost every country are aggressively raising interest rates. And, now that there is interest on deposit accounts, investors are dumping stocks. Many tech names are down 40% to 60% in 2022 alone. And Apple has a number of other issues to contend with. There seems to be a lot of management turnover recently. Apple is facing an ageism lawsuit from one of its directors. And, suppliers to Apple are also weakening. For example, Shares in Corning have been trending down recently. Corning reported weak guidance in its Q3 earnings call. Management blamed the weak guidance on slowing smartphone glass sales. Corning makes glass for the top electronics companies, like Samsung and Apple. Apple reports Q3 earnings this week amid speculation slowing consumer iPhone 14 sales. Maybe overall slowing iPhone sales will not hurt the high end of the market. We will see. Corning said downgraded revenue expectations from $3.55 billion to $3.75 billion. They said that they would need to see positive signs before upgrading guidance. Corning said that smartphone unit sales declined 14% year-over-year for Q3. Corning's largest business is in making cables for fiber optic systems. That business grew 16% to $1.31 billion in Q3. But display sales fell a whopping 28% year-over-year in Q3. Corning reported Q3 revenue of $3.49 billion. And, if you follow this channel, you probably already know that tech companies are sensing weak macroeconomic conditions. It is fair to say that Q2 earnings were weak or weakening in most companies, aside from oil companies. Inflation is raging in most parts of the world. Central banks are aggressively raising interest rates in order to tame inflation. Consumers' budgets are getting tighter because of having to spend more on gas and food. So, consumer discretionary spending is weakening. Corporate marketers are cutting their ad budgets, especially online. And ad revenue is the lifeblood of many big tech companies. Layoffs at big tech companies are big news because the biggest tech companies went on a veritable hiring spree throughout the pandemic. But the United States is now teetering on the brink of recession and the digital ad market has plunged. Realistically, there are probably a bunch of people at the company who shouldn't be here, Mr. Zuckerberg said at a company town hall in June. Meta head of engineering told managers to fire all employees who were coasting. And the market capitalization of Meta has fallen by over $685 billion since its all-time peak in September 2021. The market capitalization of Google is down 27% over the past 12 months. Alphabet chief executive Sundar Pichai said, Google employees should be more entrepreneurial. Mr. Pichai said that Google needs to be 20% more productive. Although he did not give details on exactly how that would be done. Snap has publicly announced layoffs of 20% of its employees. This comes after Snap grew its headcount by 65% within the past year and a half. Google, Meta, and Snap are probably the most notable of the companies reducing headcount. But there are many others. Real estate platform company Compass has completed its second round of layoffs. Compass has yet to become profitable as company. Compass has invested $900 million in its technology platform. Wall Street analysts are now valuing profitability over prospective growth. As a result, unprofitable tech companies' shares are getting punished. It seems that the day of reckoning for tech unicorns has arrived. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. Twilio, another unprofitable tech company, is pretty much in the same boat as Compass. Twilio announced the layoff of 11% of its employees. Twilio took a $90 million in charges related to the restructuring plan in the third quarter. It comes amid a broad macroeconomic downturn in the United States. The Federal Reserve is aggressively raising interest rates. And, the United States is teetering on the brink of recession. A year ago, this seemed unthinkable. But now it is seeming like an ominous sign of things to come. Oracle, the worldwide software giant, has cut hundreds of positions but declined to say how many. Most job cuts are said to be in the customer service unit for U.S. customers. Online stock brokerage Robinhood cut 23% of its employees. This was the second round of layoffs for Robinhood. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.